This is the future of finance. Hi, everyone. Welcome to the future of finance. I'm Georges Dyer, and today I'm speaking with Bob Smith, the co-founder, president, and co-chief investment officer of Sage Advisory. Bob started Sage in 1996 and talks about how his approach has always been to invest clients' money with an eye to what the purpose of that capital ultimately is, which has led them to really focus on simplicity, transparency, and liquidity. It also prompted them to get into socially responsible investing early. We talk about their work developing proprietary ESG models for their fixed income and ETF products. We also cover the political context, the anti-ESG pressures, and what tariffs might mean for efforts to create a sustainable economy, and much more. So I hope you enjoyed the conversation. If you're new to the show, or if you haven't done so already, please give us a follow, rating, and review, and share with others who might be interested. It really helps get the word out and help drive more capital to positive impact. So with that, here's Bob. Bob, welcome to the podcast. Thanks so much for joining. How you doing?
I'm doing fine, Georges. Thank you very much for having me.
Yeah, it's great to see you again, and very excited to share your work with our audience. And so why don't you start there? You founded Sage Advisory in 1996, if I'm not mistaken. So you've been at this a
Yes,
long time. But tell us a little bit about, what prompted you to start the firm and what Sage does.
sure. Started the firm was just an entrepreneurial interest to kind of follow my own heart in terms of how I think investment portfolios should be put together and managed. And so I was brazen and young and no assets under management, found a partner, and we started basically as the quintessential two guys in a Bloomberg with an idea. And the way we started out was really with the notion of being a liability-based asset manager. And, that was a notion that back in the late 90s, nobody really cared about because if you didn't manage stocks and have the latest growth in technology stocks, you were a nobody. But the vast majority of people that we knew were actually investing money for a purpose. And most of the purpose of an asset is really described by the liability that it's trying to fund over time. Object of the game for us was to find out what would be the frequency and the severity in terms of how that asset that you save changed into an expenditure and how efficiently is that carried out. And so we became different. And all of a sudden, people became more aware of what we call the utility function of money and that approach to investing as opposed to assets trying to beat other assets that had no bearing on what you needed to get done.
Hmm.
So that actually resonated with a bunch of people, and that's kind of where we started.
Interesting. And so that I was looking at your website and your firm's philosophies, one of which is purpose-driven investment solutions,
Mhm.
which is what you're talking about. So talk a little bit more about what that means and how you think about that, and yeah, how you relate to your clients with that.
Sure, sure. Relative performance is great. And we all aspire to be the best manager compared to other assets. But, what the mission of an organization may be isn't just to essentially get the best performance out of their assets. Sometimes I need to have specific cash flows, or I need to have a certain amount of money on a specific date to
Hmm.
fund the final payment of X, Y, or Z, fund my retirement, pay for college. All of these things are completely devoid in any assets versus asset index comparison. And so what we try to do is to get behind the reason for the money. What are we
Hmm.
trying to achieve? And the second thing is that we want to do this with the greatest amount of simplicity and clarity possible. Investing is very complex. We're constantly battered every day with macroeconomic events, political events, all kinds of intrigue that occurs across the spectrum of the investment management world. The idea here is how do I make this simple for my client? How do I make it clear for my client? And more importantly, how do I make it transparent? Life changes, and so your portfolio needs to change. It needs to be adaptable. It needs to be able to shift with with the needs of your life and with your experience. And so liquidity becomes an extremely important aspect in today's world. For example, everybody over the course of the last several years has become more than ankle, knee, and even hip deep in private investments, be they private equity, be they private credit, private real estate.
Hmm.
What that means is that, yes, I am willing to give up liquidity because I don't think liquidity will count for much for me. And therefore, I'll stretch and add more risk, less liquidity, less transparency in the
Hmm.
hopes of of earning more. Well, in 2025, that has been a completely different experience.
Yeah.
And so people like us, they sat there and said, look, you can have some of that, but you shouldn't go overboard with that. And when you start getting announcements coming across the tape that Yale is now going to liquidate a significant portion of their private portfolio, and quite frankly, will be doing that at significant discounts, that definitely puts a chill in the spine of a lot of other investors that followed, who
Yep.
said, I can be like Yale.
Hmm.
Fact is, that's a tough act to follow.
Yeah. Yeah. I saw that news, and I think liquidity is certainly at a premium now.
Mhm.
And well, tell us a little bit about who your investors are, like sort of where did you start and sort of how has that evolved over the last 20, 30 years? Is it a mix of individuals and institutional, or what types of investors
Well,
attract?
Sage is first and foremost an institutional firm
Hmm.
where we manage close to $30 billion in AUM.
Hmm.
The vast majority of that is institutional clients. We do service individual clients, but mostly through the realm of investment platforms of other intermediaries, be they Morgan Stanley, Northern Trust, Wells Fargo, you name it. So we are approved and exist on about 22 different platforms and available to people in that way
Hmm.
through their advisors. We do a fair amount of one-on-one engagement with our clients. And we are primarily focused on three things. One is fixed income management, everything from cash management all the way out to core plus, taxable, tax exempt. And then we also do a lot of asset liability analysis or structured portfolios that are very specific and oriented towards a specific liability objective. And then the third thing is our ETF strategies that we have done ever since the late 1990s. We are one of the earliest advisors in the models and ETF model strategy game. And in our ETFs, we also have ESG optimized strategies. And in our fixed income portfolios, we offer both traditional and ESG or sustainably optimized strategies and have done for the better part of almost a decade now.
Yeah, let's talk a little bit more about that. How did that kind of come about, and particularly in the fixed on the fixed income side? Maybe just tell our listeners a little bit about what that looks like in terms of,
Sure.
integrating ESG factors into those decisions.
We have, yeah, I think like most in the industry, our entrance into that came back in about 2003, 2004, when our clients were asking us if we could essentially adhere to socially responsible principles and do negative screening,
Hmm.
which we could, and we did. And over the years, we had more and more clients ask if, in fact, we could do SRI related investing. As time went on, though, and as the evolution of sustainable and responsible investing continued along, after 2006, 7, 8, and going into the teens of this century, we, like most, started to realize that this was not really capturing everything. That was the negative screening was one aspect, but what we know what you don't want, but what do you want? What do you want to embrace?
Hmm.
How do we find that? And so, with that, we started to see more and more capability in terms of data provision and various different sources of information that we could engage with that would allow us to essentially not only do the negative screening, but embrace the positives and be able to lean into various aspects of what was being desired by our clients or was held in their values, because we also had a lot of religious clients, Catholic, as well as Jewish, as well as Christian faiths that had various value sets that were very much aligned with the ESG spectrum
Hmm.
in different ways. And so we wanted to be able to build portfolios that reflected that. And in order to do that appropriately, we built our own ESG process, so quantitative scoring system called our Leaf Score, which we have done and applied to our clients now for well over 6, 7, 8 years. We report to our clients every single month by QSIP what and holding in their portfolio what their leaf score looks like. It's a 1 through 5, 5 very strong, leader, a 1 a laggard. And with the idea that, look, we want at least average, if not above average, within every portfolio that desires a high degree of sustainability or has a value set that's very aligned with the principles of sustainability. And oddly enough, as we went through the heyday, if you will, of ESG, people kind of jumped on board with that. They said, okay, fine. Yeah, I don't know how this adds value. I said, well, part of the reason why is that A, you don't see it tracking in your portfolio. B, you don't see how those scores, just like your credit rating, align with the return that you're generating in the portfolio and how that compares to the broad market. But let me show you that. And many of our peers still weren't doing that. And one of the things that we also wanted in this process was a notion of independence. We received data from half a dozen different sources and all the name brands that you might know. But what we don't want is their opinions. Give us your data. We will have our own opinion. We will have our own weighting to how we want to, what level of import we want to attach to a given metric within all the metrics that we review for the benefit of our clients. We do it on 2 levels. One is that we want to look at the industry first and foremost, because as you know, George, certain industries can't get out of their own way because they're just inherently problematic from an environmental standpoint or have had historical problems with regards to several social issues and so forth. And so we want to understand that, let's understand the difference between what can be managed away with good management and governance, and what is an inherent issue that can be managed but can't be managed away. So that's the first thing, is to understand each industry in and of itself, of all the industry categories, how to think about it from an ESG or sustainability standpoint. And then secondly, within each industry in and of itself, to sit there and say, who are the leaders, who are the laggards, and to be able to look at the issues of materiality that we would look at inside just the industry and apply that to each company, and then understand exactly how those are applied. And what we want to do is to look at a company in terms of what it has been compared to what it is today across a huge span of metrics, what it looks like either versus leaders or laggards within its industry. And then thirdly, we want to look at what it intends to be as it has stated, and how far apart are we from the intention and the actual achievement, and is it realistic? And so those are things that we try and sift through very quickly through our system to allow us to build portfolios that we think from an ESG perspective, and even in the world of fixed income where you have longer term investments, environmental factors matter, social factors matter, governance factors matters, and it matters most importantly to the credit rating agencies who are consistently integrating these data points into their rating system. It'd be foolish of us as fixed income managers to ignore how and why Moody's and Standard & Poor's and Fitch integrate this into their process. And to sit there and say, well, I don't care, it doesn't matter. Well, if it matters to them, any change up or down that they have in their assessment is going to have an impact on the bond price, and therefore it's going to have an impact in my portfolio. And so we want to make sure that we have a very full view. And we often say to ourselves, there's a lot of things in the world of ESG analysis that are nice to know. But really what we want to know are the things that are important and you need to know that really drive capital value in that organization within that industry. And that to us is very important. And the last thing I tell you about that is that governance is really, really important for us. Governance, as far as we're concerned, tells you everything you need to know because, as Robert Eccles once said, no one is accidentally environmentally sensitive. It happens through intention and action and execution.
Hmm.
And so what we want to understand is how important that G is and how does it drive the process.
Hmm.
And so, again, bringing it all together is that, we think that, in the absence of this kind of analysis, it's very difficult for anybody to sit there and say, well, I'm very, sustainably focused and I care about resources and I care about this, that, and the other thing. We live in a world where we're all from Missouri. It's the show me state, right?
Right.
So, I think that, we want evidence of this and we want to be able to track it over time.
Yeah. And is that process more qualitative or quantitative? Or I mean, are you kind of going in and talking to management and sort of getting your assessment of how,
Yeah,
authentic they are to those intentions
great
versus,
question. Great
yeah.
question. The answer to that is yes. And we try to engage where we can. Since we don't vote proxies as a fixed income investor,
Hmm.
believe it or not, it's really, really difficult sometimes to get uh, public information officers at companies to talk to you.
Hmm.
They really care if you're an equity investor. You get a second class ticket if you are a bond guy.
Hmm.
But we battle through that, and there are some companies that are really, really sensitive to it. In particular, the multinationals, where they clearly have exposure in Europe and Asia and elsewhere, and they're very sensitive to this. And this is part of their corporate communications on a more global basis. Yes. And so we try to engage, but we also engage and with the professional organizations, whether it's the CFA Institute, whether it's PRI, SASB, everybody, we have levels of engagement. In today's world, you got to be careful because that collaboration could be construed as some kind of antitrust activity, and we got to make sure that here in the US we don't fall into that trap. But
Hmm.
our engagement process also extends even to our ETF strategies, where we have for the last 6 years have created one of the only, if not only, survey of the ETF industry of all the major producers of ETFs and asked them about 60 questions about their governance, about their process, about their sustainability practices, and about how they treat their proxies and so forth. So it's a stewardship survey, and we really wanted to study stewardship.
Hmm.
And what we have found, that as an ETF investor and as somebody who offers a lot of ETF strategies through a bunch of different models, that not many of our peers really sit down with the BlackRocks, with the Vanguards, the State Streets, and I can go on and sit down and say, okay, so if I invest my money with you, can you tell me how you're going to vote the proxies that I have associated with the money that I have from my clients?
Hmm.
I'd really like to know that. The vast majority don't ask the question,
Right.
which we find amazing. We have asked that question, and you'd be surprised what you find out. The sad thing is that based on our analysis over the last 6 years, that we think that stewardship has declined
Yeah.
and is declining, and which
Do
is
you,
unfortunate.
do you think that's because of just more move to passive or just because of the political environment or just what do you think are some of the reasons behind that?
Clearly a political environment.
Yeah.
No question in our mind, no matter what they say.
Hmm.
You see it not only in terms of the forms of the responses, which 3 years ago, you would have said this was crafted by somebody who is an analyst,
Hmm.
maybe on a due diligence team and so forth. We now look at them, many of the answers, and say, well, this is crafted by those same people with their lawyers.
Hmm.
And so there's clearly been a walk back, if you will.
Hmm.
And I think that we've gone from an environment where, in principle, when it came to proxies, there were two things that are bothersome. One was proxies are very complicated. The issues are very complicated. Most people out there who are buying, an ETF of the S&P 500 or whatever sector they're buying, quite frankly, this is Joe and and Bertha out there on Main Street in their 401k or whatever. They don't know what to respond to.
Right.
And so you used to pay for that service through your fee for one of the big providers of ETFs to essentially act on your behalf.
Hmm.
That's no longer the case. We're now
Yeah.
going to a yo-yo environment. You're on your own.
Hmm.
We want you, Mr. Joe Retail, to vote this very complicated proxy.
Yeah.
And the issues are very, very difficult to understand, but you go ahead and you make a decision.
Hmm.
Um, that's a
Yeah.
problem for us.
Yeah.
And I would dare say there are many institutions like, I don't understand what way we should vote on this.
Hmm.
And so I think that we have seen stewardships suffer a bout of retrograde in the last 2, 3 years.
Hmm.
And hopefully we're kind of bottoming out, but time will tell. But I
Hmm.
think that here again, the issue for us as fiduciaries is to really create portfolios where we are responsible for every aspect, and not just the things that we feel we're not going to get in trouble on politically.
Yeah.
You the world has changed, and so we must adapt. But
Yeah. It's a challenge. I mean, these issues represent real risks, and I think investors are doing a good job of raising those risks to companies and working together to address them. And I
yes,
think my fear is this stops or as it slows down, those risks just increase again.
yes.
Yeah. Well, we've talked a little bit about this already, but having kind of been along for this ride for the past 15, 20 years around this whole SRI ESG field, um, I mean, what do you think are sort of the pros and cons in terms of how it's changed? You talk a little bit about the engagement piece waning in the last couple of years,
Mhm.
and that's not been a good thing. But yeah, where have you seen bright spots? Where have you seen the biggest concerns, and what would you say is sort of most needed in the field right now for it to be
Sure.
successful?
No, that's a good question. Um, yeah, I think the way you kind of framed it out is, when you sent your note was, has it gotten better or worse,
Hmm.
in many respects. And I think in the ways of thinking about it as getting better, I think that we can honestly say there is now more mainstream adoption,
Hmm.
um, that ESG or sustainable investing or responsible investing has kind of moved away from being kind of a niche concept, and it's probably a little bit now more in the mainstream, where is a core consideration for investors,
Hmm.
for companies, for policymakers, and so forth. And degrees of importance will shift. But if you sit there and say, look, at the end of 2024, according to Bloomberg intelligence, there's $30 trillion that are still, invested according to kind of ESG related kind of guidelines and frameworks. I think that widespread integration is going to continue on. It may go into a little bit of a slowdown here in terms of the upward trajectory, but
Hmm.
it's not going to go away. I think there's been a lot of regulatory progress. You look at the frameworks from the EU,
Hmm.
the SFDR, and then you look at the Task Force on Climate Financial Disclosure, TCFD. They've all standardized reporting, and I think that's a good thing. That's a positive from where we
Hmm.
were a decade and a half ago, where it was
Yeah.
somewhat chaotic and nascent. It's
Hmm.
now a lot more concrete, I think, on many levels, which is good. And then we can also see that some of the pluses are corporate actions. And yes, I think that companies are interested in renewable energy in a lot of different ways, and they're kind of chasing after that, whether you want to, whether you're a pro or con on the nuclear side. But I think what we're seeing with regard to AI and the power generation requirements has now taken us to a, kind of all of the above categories. So it's,
Yeah.
yes, some fossil fuels, but air, wind, solar, everything, is thrown into, consideration now, which I think is a positive. You got more consumer awareness than you've ever had before. Everybody likes sustainably oriented products. They like plant-based kind of stuff. EVs. I mean, all of this tells me that, yeah, part of your goal has been achieved in the sense that a lot of the consumers out there, you say, well, do you want something that's natural? Yes, I prefer natural rather than something that's manufactured. Okay. So I think that we've done pretty well there. And I think the technological advances are a big plus.
Yeah.
Carbon capture, renewables, sustainable agriculture, carbonizing a lot of our industries are bringing it down. All of those are positive. Now, on the negative side, I think there is still a fair amount of prevalence in terms of greenwashing.
Mm-hmm.
I'd say on the pro side, there's green hushing. Nobody wants to admit to it publicly, but they're doing it.
Yep.
They are green sensitive, but then on the other side, you still have greenwashing. And there was an interesting study that was done by MSCI, I think in 2022. I have my notes here. It said 65% of the ESG funds had questionable alignment with stated goals. And
Mm.
um, and that was kind of interesting that they, of all people, would come out and make that statement, 2 years ago. And I'm sure that population has declined significantly since a lot of guys gave up the ghost here and said, that's it, we're shutting it down.
Right.
Political backlash has been harsh.
Mm-hmm.
We have felt it. We here at Sage have been subjected to two congressional inquiries
Mm.
and one by the state of Texas as well
Mm-hmm.
on our ESG practices. And essentially, if you read between the lines, you felt like it was a bit of a McCarthy era type of criminalization.
Mm-hmm.
And so that makes you kind of sit back and go, what do we do here?
Yeah.
And it does cause you to pause, but we believe in the right of free speech, and that everything that we had done and had ever written has always been one thing: pragmatically crafted and really driven by our fiduciary instinct to be a better manager and to consider all risk all the time, and to
Mm-hmm.
be able to put a finger on the pulse and say, we got a good read on this. We know what's
Yeah.
going
Yeah.
on. And so we feel that's very defensible, and that's the way it should be defended.
Mm-hmm.
We still have inconsistent standards. I think there was one study that was done by MIT a couple of years ago. They said there are 600 ESG rating methodologies around the world.
Mm-hmm.
Yeah, and that's just like, okay, all right, man, it is starting to feel like a bowl of spaghetti. And I think that's why we decided that, look, we're just going to go and do it the way we think we should do it. And we'll beg and borrow various parts and aspects of it, because there's no such thing as, brand new under the sun for very long. But we were trying to craft an approach that could be understood by our clients, first and foremost. And secondly, had that rinse and repeat capability in terms of reliability,
Mm-hmm.
in terms of access to data and the hardness of the data. And then I think that you have the last thing I would say is kind of there's a social and kind of governance lag in that, the governance issue still, and the anti-corruption stuff still, even under the current administration, probably are being put to the back of the church in the sense of not a major concern here. I think it is a big concern. Governance has always got to be a front and center kind of concern for everybody. And everybody thinks that, every company in their portfolio is the best run company. Should really sit down and start sifting through the numbers, because they'd be shocked to find out that they're not. But I think, for us, I think it's better. The environment with regard to sustainability is better. You got certain caveats in there, but I think the progress that we have made is durable.
Mm-hmm.
I think that the thinking that has always been there for people who have very strong value orientation, they have a mission that really identifies what those values are and consistently applied over the decades, are never going to depart from this world.
Right.
And they are always going to be, holding fast to the principles in ESG. So, for some, ESG was a fashion statement.
Mm-hmm.
That's not us.
Mm-hmm.
And then even within our client base, I'll be honest with you, George, not everybody's in love with the notion of a leaf score showing up on their portfolio statement every month.
Mm-hmm.
They fight it.
Yeah.
And certainly under the current political environment, we've had clients that say, please don't show that anymore.
Mm-hmm.
And then there are others say, look, oh, I love this. This is wonderful.
Right.
So trying to serve both in a world of technology as we are today, that's easy to do.
That's the
But
good
I
news.
think the underlying principles for us never go away.
Yeah. Well, that's the, I mean, sticking to rationale, as you say, the fiduciary duty aspect, that these are real risks and opportunities that any investor should be looking at, no matter
Yes,
what
sir.
you call it. And, it's an interesting thing about the language, obviously, is some of this has become politicized. Do we need to stick to this acronym and this language? Because underlying it is just what investors have always needed to do. And I think these frameworks have just tried to make it clearer, make it more explicit, give these sort of, more systematic ways of looking at these issues. But,
Sure.
things that were complex or maybe a couple of orders of magnitude, kind of a couple of steps removed from the traditional financial statements, but still very
Sure.
much financially material.
Sure.
So yeah, I think that's the way to do it. And, in some ways, I hope that this kind of pressure helps strengthen the field in the language and everything. But at the same time, it's super unfortunate that it's just a big distraction. And I think for firms like yours that have to get called in and explain yourselves to politicians and stuff, I'm sure that's a distraction and time that could be better
Well,
spent elsewhere.
again, if you honestly, like we do, so look, first thing is, as a fixed income investor, very little to really pick on you in the sense that, look, we don't vote proxies.
Hmm.
And even if we did, we kind of vote them the way we kind of evaluate our companies consistently.
Yeah.
I think the issue from my perspective is that, when you look at the CFA Institute, which is supposed to be, that is the accreditation that, the vast majority of people who are serious professional investors in the institutional space kind of aspire to have.
Hmm.
There they have it. It's all laid out. It's, the principles of responsible investing, ESG investing, and so forth are all there. They're tested on it. They give you even a certification on it, which I have. But I mean, the fact of the matter is, it's not going to go away. And many of our younger investors and professionals have been, to some degree, over the last 10 years, weaned on this.
Hmm.
They understand it. And politically, whether or not they adhere to it, that's another thing. But factually and contextually, they get it.
Yeah.
And that's the important thing. And
Yeah.
so it was for Pope Francis as well. I just wrote a piece on Pope Francis, and it was in memorial to him as a stalwart of environmentalism.
Hmm.
Forget about all his other religious values, but what he did in part to ensure that the church would incorporate within its teachings many of the issues that we find in our ESG framework that he embraced. He put it into the teachings and the curriculum for young priests.
Mm.
And through the years, this will continue to kind of percolate.
Yeah.
And,
I saw
so,
that piece that you all did on him and Laudato Si, and I thought it was great. A lot of your thought leadership is excellent, and would encourage people to go check it out on your
thank you.
website. But I thought one of the great points that you highlighted there was in Laudato Si, how he really pointed out that there's no separation between these environmental issues and these social issues, that they're really so integrated. And that's another piece I think people can lose sight of when we're talking about quote unquote environmental issues, that it's really about people and people's lives. And
Mhm.
mhm.
Totally.
Yeah.
Very connected. Everything, yeah, and we kind of know that intuitively,
Hmm.
but I think sometimes people get afraid to state it publicly, and he
Yeah.
didn't.
Yeah. Yeah.
Um,
He's
so,
It's
um,
amazing stuff. Well, speaking of some of your other thought leadership, I know you all have put out some work around the tariffs, obviously, as everybody's trying to figure that out. And just kind of curious, I don't usually dive into sort of the market issues of the day, but this is just such a big and interesting one. I'm just curious how you see that. Obviously, just as an investor, you're trying to work it out like everyone else, I imagine. But how do you see it
mhm.
tying back to some of the sustainability issues? Do you see it as a good, bad, neutral, mixed in terms of.
I think the bottom line is that we're kind of mixed and we're kind of maybe leaning neutral on that, but I'll tell
Hmm.
you, kind of the positive, the negatives. Positives would be, this probably boosts local production,
Hmm.
right? Because you're trying to incentivize domestic manufacturing, reducing emissions from long distance shipping and support local economies, right?
Hmm.
So that's good from a social perspective. Yes, we know that all these super tankers that are going across the Pacific, the Atlantic, and so forth, they're just dumping tremendous amount of carbon emissions into our water, into the air, and so forth. So to some extent, short-term gain because carbon emissions will go down. We saw that also during COVID.
Hmm.
So, yeah, and to the extent that you bring it back home, rather than shipping it halfway across the world, that's probably a positive. It's just a question of how much. And you're also, your supply chains become a lot shorter. They get less stressed, like we saw during COVID. If somebody decides that they don't want to play ball anymore and you have this extended supply chain, perhaps it's better to have something a little bit more domestically located. And so I think just everything related to transport, carbon footprinting, and things like that, I think it's a positive. I think it could be innovative to green tech, because they're trying to bring this stuff home rather than import it. So, they could foster investment in sustainable technologies that are done here. So rather than have Chinese solar panels, because really the solar panel business in the United States is a solar panel installation business,
Hmm.
not a solar panel manufacturing business. We need the manufacturing business. And again, that if you believe in that technology, and we do, it's part of the solution set, then having it built here in the United States is a positive. One of the issues that you're concerned about is obviously all the rare earths and things like lithium and so forth that are important. We don't have as much as we would like, so that's the problem. I think
Hmm.
the third positive is that you're going to reduce overconsumption. And I think that, if the United States is anything, it consumes a lot more than it probably needs.
Hmm.
And so the idea of curbing demand for, resource intensive kind of goods, and having more of a sustainable consumption trend established because, look, I just can't get it or it's too expensive. I don't need to have it. I think that's a positive to some degree, right? On the negative side, you're going to have increased cost for green tech because obviously, if you don't have all the materials, raw materials, like I said, rare earths and lithium, they're just going to jack the prices, and that's it. You're just going to pay more for that. So it could slow the adoption of green tech adoption. There's no question. You're going to have your supply chain disruptions, and those are always a problem. And they're not quite fair. I mean, if you think about California or any of the cities where we do a tremendous amount of trade, import, export, clearly those local communities are getting hurt.
Hmm.
Unemployment will rise, dissatisfaction within the communities. It's hard to start that whole thing up again. So it then gets passed on to consumers, and that's not good. Trade wars are never good. Retaliatory trade wars even worse. And so you start to get away from this idea of having things like the Paris Agreement, work. Everybody kind of gets very self-interested rather than looking to create partnerships. They could kind of take care of themselves first and only. We know the battle cry of the current administration is, make America great, America first, all that kind of stuff. Well, the Chinese can say that and the Europeans can say that. It doesn't get you anywhere.
Hmm.
And then I think the last thing is that you get this policy misalignment on the environment. You kind of sit there and say, well, we want to protect the high carbon, industries, like coal, clean coal and steel. Okay. That's great. But you're essentially unlocking practices that, quite frankly, are going to, again, create an environment where you slide back to the past. Okay. It's like Back to the Future, right? Yeah, and so, yes, I think that there are problems for us. It's also about implementation. The one thing that would be really interesting is if you had tariffs that were tied to carbon intensity, that you could promote sustainability by penalizing high carbon imports. And then you can, yeah, because the blanket tariff thing doesn't seem to work. But maybe if you had a sustainable kind of orientation to this whole thing, you could say, look, we want to decarbonize the world. We're going to put heavier tariffs on carbon producing kind of products that we're importing.
Hmm.
And we may produce them here domestically, but it won't be as expensive, that kind of thing.
Yeah.
But I don't think in the current environment in Washington, you're going to get that.
Nope, I don't think
Uh,
so. But it's a
but again, I think, there are going to be short-term disruptions, maybe some long-term benefits, but we come out on this thing fairly neutral at the moment.
mhm.
It's kind of hard to put an exact finger on it because you don't know which players are going to get hurt the most. I mean, let's say, for instance, you transfer, India, caves, and they come in and say, okay, fine, we've reached an agreement. And then all of a sudden, everything transfers over from China to India, and on a relative basis, are they using less coal-fired plants? Are they generating, various industrialized products and exports in a way that protect human capital, child labor laws, all that kind of stuff?
Hmm.
Hard to say that you net improved anything other than the terms of trade for importing the United States.
Yeah.
From an environmental and say from a social perspective, it may be just as bad as it ever was.
Hmm. Yeah, well, it's a
Hard to know.
super interesting breakdown, and I think, yeah, I mean, I think clearly intent is not there to to achieve some of these goals, unfortunately. But
Hmm.
interesting to see what some of the unintended impacts might be. But yeah, I think regardless, just the way it's being rolled out and the speed and uncertainty is going to certainly,
Hmm.
unfortunately, lead to significant pain in the short term, most likely. But yeah, it's interesting. I think it's generating a lot of interesting conversations along the lines of what you just laid out about, getting people to really think about consumption and where stuff comes from and, what we can do here more locally. And those are, I think, some good conversations to have. Um, so, Bob, we're close to wrapping up here, but I have got a few just kind of quick rapid fire questions for you if you're up for it. Um, so, what's just one book, podcast, article, or some resource that you might recommend to students or others interested in this
Uh,
space?
well, one, yeah, because we kind of did a little quick survey. I think there's a podcast, Disruptors for Good,
Hmm.
is hosted by Grant Trahant, and that he features interviews with entrepreneurs and leaders who are making a positive impact in
Oh,
terms of
cool.
their sustainable practices. So that might be something to look at or listen to. And then I know Morgan Stanley, they just published an article on sustainable investing, kind of in the title of Interest Remains Strong in 2025.
Hmm.
So they kind of have a very good overview that they provide in terms of all the current trends in sustainable investing, where they see money going, how the retail investor is doing versus the institutional and so forth.
Hmm.
So those would be a couple of quick thoughts that
Nice. I
I
love
would
it.
share.
Good ones. And what about the biggest myth around sustainable investing that you wish we could just move past?
Leads to lower returns.
Hmm. That's the one.
I'm so tired of that. ESG is just inherently a poor second, third, or fourth when it comes to performance. It's not true. Not true at Sage.
Hmm.
And so, there are days where, it's a little bit behind, just like everything else, but in the majority, it is equivalent to, if not better than, even my traditional products.
Hmm.
And I have products that go side by side.
Hmm.
Intermediate fixed traditional, intermediate ESG optimized, okay? And I often do what I call the Coke and Pepsi challenge. I take two portfolios, one from each group. I
Hmm.
don't have any labels. There's no leaf scores or anything. I said, okay, here's the duration, here's the maturity, here are the holdings, that's the sector allocation. Which one is ESG optimized?
Hmm.
What? Yeah, go ahead, pick it.
Yeah.
And I would say over 50% of the time they picked the wrong one. It's the absolute truth. So
Hmm.
I think that part of the problem here is that there's a lack of awareness and there's kind of a historical bias against it
Yeah.
in the sense of, how do I deploy it and how do I recognize it? And I would say we as an industry have done a poor job of really illustrating it consistently.
Hmm.
And because it's very Pavlovian, you got to have to constantly reinforce, reinforce, reinforce.
Yeah.
And that's why we put leaf scores on statements. That's why we write what we write in terms of our research and so forth.
Hmm.
And so I think that's the important thing that over time, as the more you educate investors and the more you promote the transparency, that's the important thing. There's no mystery in this. And then you have to have the research. The written word's really important here. And so, look, it's not going to hurt you. In fact, it's going to benefit you. And in the last 3 months, would you rather have had a traditionally focused equity portfolio or an ESG focused one? I guarantee you, everybody would put their hands up, say ESG, ESG, ESG. Why? It has done on a comparative basis, sustainably focused, ESG focused portfolios have outperformed during this big swoon. They have done extremely well.
Hmm.
They have defensive qualities that have really shown through. And a lot of it because of the international exposure, a lot of it because of the orientation in terms of the industries that you're invested in. You can do all kinds of attribution, but the fact of the matter is the numbers are good
Yeah.
and have been good. And so I think the shining moment for those who are sustainably focused and responsibly focused is here in 2025. It's in here, and you can see the numbers. Even Morningstar just put out a report about 2 weeks ago talking about that.
Hmm.
So, when the chips are down, maybe good old responsible investing comes through for you.
Yeah. I love it.
You know?
How about someone who's been really influential to you on your sustainability journey and learning about all these topics?
Yeah, there's so many people. I know you, Georges, you come across so many people, but I got to tell you, the guy that I often enjoy because he speaks his mind and he makes himself so very available is Robert Eccles.
Yeah.
He for me has been very influential, and particularly when it comes to reporting and integrating kind of the regular quantitative stuff and then taking some of the less quantitative information and integrating it with the quant stuff so that you come up with a kind of a more comprehensive assessment of what an organization looks like from a sustainability standpoint. So I think he's really good for that contribution. I'm grateful for that. He's also the founding chairman of the SASB, and so he rallied the troops. And his thought leadership is great. I mean, this is somebody that he's got a great sense of humor,
Hmm.
easy to talk to, and as I said, makes himself available. And if people want more, all they got to do is go to roberteccles.com. Website's there,
Yeah.
and enjoy the ride.
Yeah.
And
It's a great one. I
I
was going to
think
say
it's
his research, there's a lot of stuff he's published a bunch, so if people aren't familiar with him, you can find him pretty easily. And yeah, the SASB, the Sustainable Accounting Standards Board, for those who don't know that one, is a huge contribution to the field.
yeah,
And he's done a lot of work on the political or the depoliticization of all of this and trying to
indeed.
move past, which that's a tough
Yeah.
task because a lot of it's not based in rationality, as we know.
Mhm.
But still, I think it's important to try and do that. All right. So if you could snap your fingers and have one policy, one public policy regulation to help create a sustainable society, what would that be?
No, that was a tough question. When I saw you send that, like, oh my goodness, there's so many. I think the most overriding, perhaps the most globally sensitive one would be to mandate comprehensive carbon pricing
Yeah.
and require all countries to implement a carbon tax, or a cap and trade kind of system, that really puts a price on carbon emissions.
Hmm.
And why do I say that? One, we need to have a system that incentivizes reduction of carbon emissions, right? So you got to make it costly.
Hmm.
Go ahead. You want to do that? That's fine. You're going to pay for it. And so that expense structure will incentivize more and more reduction. It will also promote innovation. People, will find cheaper ways of achieving lower and lower levels of carbon emission if they're forced to, and it becomes expensive. And then when you raise that money needs to be redirected. And this is where the circular economy notion comes in. We'll take that money that we receive from the decarbonization, and we're going to apply that to conservation efforts and to renewable energy products and so forth that are proven,
Hmm.
as opposed to picking winners and losers and so forth. And I think that we can understand now what those might look like more and more going forward. So I think to me that's number one,
Yeah.
And
That's always my pick too. We had, I don't know if you know, a guy named Mike Aslan on the show a few episodes ago, and he runs a firm called Carbon Cap Management, but is talking a lot about this and just how some of those carbon pricing regimes have been really successful at doing just that and circulating the money back into solutions.
Mhm.
And I think it's always important to remind people too that it's not just taxing these activities as a sort of punishment or discouragement, although it does that. It's really about accounting for the true costs
Yep.
of using them, of burning them, because we're going to pay those costs one way or another, whether it's through taxes or insurance rates or whatever, when we start feeling the impacts of that climate change. So it's a
Mhm.
market failure that needs to be addressed, and as you say, will then drive all kinds of innovation and solutions. So I'm completely with you on that one. All right, what are a couple things you like to do outside of work?
Oh God. Right now, I am into doing some hikes. I'm skiing more than I have because I had suffered an injury a couple of years ago. So
Oh, nice.
skiing and biking are two of the things I like. I like going out for good long walks with my dogs and just enjoying nature. I have a house in Santa Fe and a house here in Austin, two lovely communities. So,
Hmm.
it's very difficult to find a reason why I shouldn't be outside.
Yeah, a lot of good nature to enjoy.
Yeah.
Fantastic. Well, Bob, our final two questions we ask everybody. Given all of your work and perspectives on this, what is your vision for the future of finance if we were to make this a reality?
Um, I guess it's where technology, sustainability, inclusivity kind of all come together and kind of become the forefront, if you will, of what's we need to do. I think it has to, the elements that are going to be part of that are going to be AI and automation. We got to leverage all that predictive analytics. It certainly is going to help us in terms of, all kinds of cyber, crime and things of that nature. But I think it also helps to advance our knowledge of climate
Hmm.
and will help to advance our knowledge of climate mitigation and to bring about various adaptive technologies that we need to deploy more and more. Okay,
Hmm.
because the one big issue that we find, which is problematic, is the affordability of insurance.
Yeah.
And because of climate risk, it's becoming beyond the reach for a lot of people. And so they're now going naked on their insurable risk. So that's an issue, but we think AI and automation can help in that. Blockchain is also very instrumental in eliminating a lot of the middlemen, if you will, in blockchain that create, paper, that create carbon emissions because people have to travel to offices and so forth. There's a lot of people that takes, something that could take literally 3 minutes, if you're, are trying to, let's say, clear a mortgage or whatever, or to get it from a buyer to a seller. Uh, that can be done so quickly in blockchain rather than 3 days and 15 people later. So
Hmm.
I think that's a big issue for sustainable investing. I think sustainable finance has kind of lost its way here in the United States. It's still very much a popular item overseas, but you can see that in terms of the level of green bonds and so forth that have not been issued here in the United States in the last 24 months. It's kind of depressing, but there you have it. But I think that will come back. And I think the other thing too is that digital currencies and the inclusion that allows for in terms of more and more people can participate in the capital markets through crypto than ever before. And so it becomes now kind of a public highway to get involved in the capital markets. And I think that's a good thing. I don't think
Hmm.
that's a bad thing. It's going to take time, but I think that's important. And I think in order to make this all reality, policy and regulation has got to be at the forefront. You got to have frameworks for this innovation to work. AI, blockchain, all these things have to be somewhat unified.
Hmm.
Otherwise, you're going to have a nightmare. Then we're going to have to educate and reskill people in order to make this work efficiently. So obviously, a lot of training, which is a good thing. Collaboration is another thing that, we were doing really well there. And I think, no, we're not doing so well now.
Hmm.
But more and more collaboration rather than fighting, I think would be helpful. And then the technology spend has to happen. I mean, I know here at Sage, how we have spent an incredible amount of money on AI integration in our business over the last 3 years, and it allows us to scale our business to where we are today with no more people than we had 5, 6 years ago.
Hmm.
Although I've now got twice the size of a business in terms of the number of accounts and clients and so forth. So I know that it can work. It worked for me and continues to work for me. I can just imagine and what that does in terms of eliminating all the needless resources that you expended in order to produce, a report or to go someplace or to speak to somebody like you and I are talking today.
Hmm.
All these things are wonderful additions, and I think support the whole idea of a more sustainable world. There's no
Hmm.
question.
I
Yeah.
love it. Nice. Great. Well, and the final question here for those interested in getting into this space who, represent the future of finance themselves, what kind of advice would you give them? I know you've got a lot of talented people, including a lot of talented young people at your firm. So what kind
Mhm.
of guidance would you give people looking to work in this
Yeah,
space?
it's there's probably half a dozen things I would say. First thing is educate yourself. take those courses, get those certifications, whether it's the CFA Institute or somebody else, yes, go out and do some learning, do some reading, get all the books and articles that you can possibly put on your eyeballs, listen. Second thing is gain practical experience, internships, for sustainable investing, or working with firms that have strong ESG practices. If it's not in investing, maybe it's in manufacturing. Get attached to a project or research. I mean, a lot of research people need grunts. They need people to gather data. They need people to go out and interview people and so forth, do surveys, all that kind of work. But it's really practical experience in terms of, if I were to do this one day, what would I do? Networking, as you well know, and Georges, you do a wonderful job with IEN and so forth. The issue is, who do you know? How many professional organizations are you involved with? Whether it's PRI, whether it's GIN, it really is an issue of, it's not about what you know all the time because you can't know everything. It's about who you know. That you can't do. Conferences, webinars, that's important. Stay updated. Read, listen to the news, look at what's going on in industries and so forth. Trends change. And then, what kind of skill sets do you have? I always tell my people that, skill sets change. When I came into business, we didn't even have, anything remotely close to Microsoft Office. And today I think about it, most of my people, they can write. But more importantly, they are programming. They are writing code in Python. And they are using AI to help them do that. So I have traders on my trading desk who are writing code that 10 years ago never would have expected that.
Yeah.
So it's really, really important. And I think the last couple of things I tell you is one, be passionate and persistent. Nobody wants a stone killer in their business, and it shows no passion and, very little, emotional interest. People buy passion. They want to be associated with passion, and they want to know that you're going to be there and continue to push. So I think that's important. And then the last thing is just find a mentor. Find somebody that you really respect, that you like, and just, sidle up to them and get as much as you can out of them in terms of advice and guidance. And I think, those are the things I would say. It's pretty easy, but
just all that. No, but it's great advice and a perfect way to end. So Bob, thank you so much for taking some time out of your day to talk with us. Always a pleasure to connect, and thanks for the great work you're doing. And I hope we connect again soon.
All right, Georges, and thank you very much for having us, and very much enjoy working with IEN, and good luck with all of your efforts, and we'll talk to you in the future.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.